If you had unlimited money and no regulations holding you back, what is a fintech move that you'd make?
We would be much more aggressive in disrupting the existing payment rails across debit, credit, ACH, and other infrastructure plays.
The payments industry is the new railroad and pipeline. The payments industry is the new financial frontier. Wall Street is undervaluing payments companies because of the similarities in a traditional business model. Make sure you watch this full video today because this one is an absolute banger. What's up, everybody? Art Turner, Data Productions Media. Dreams are tangible aspirations where we scheme our dreams into existence. Like I said in the intro, we have an absolute banger today. We're going to get really into the weeds of the payments industry and how that is, going to be the archetype moving forward for how money is and money, services, goods is going to be transferred from business to business, person to person, from entity to entity. And so for this presentation today, a lot of investors in what you see on the screen, we have PayPal, SoFi, USIO. A lot of these investors who are invested in these companies, which are payment companies or have payment sections of their company. A lot of the investors often question why isn't Wall Street picking up on this technology? Why is it so undervalued or underappreciated of where these companies are going and the technology they have to make our lives financially a lot easier when it comes to different transfers, paying, and just, the energy shift, right? And so today we're going to really break that down and get into some of the reasons why Wall Street is undervaluing it, because they look at it from a traditional perspective. But I also want to give investors in PayPal, SoFi, USIO. I'm invested in SoFi and USIO. Some perspective on how this could be our opportunity, our edge when we have a long-term horizon. Because in a lot of retrospects, we are still in the beginning stages of where the payments industry is going to go. And, it's going to be a multi-trillion-dollar industry in the future. And we just want to make sure we are positioning ourselves in the right companies to reap the rewards once Wall Street gets on board. Okay. And so it's going to be an amazing presentation today. And as you know, I'm a fundamental investor, but I do also use the numerical system gematria to help come to my conclusions and make investment decisions. I am not an investment advisor. I'm not a financial advisor. So anything you see in this video is purely for education and learning purposes and bouncing ideas off each other. Okay. And so I'm really excited for this today. And to christen it all off, we're going to start with some gematria. Payment facilitation businesses connect financial entities, railroads, and pipelines. That's 333 in English reduction. We know, if you've been a part of this channel, 333, especially in the English reduction cipher, is highly energetic and highly valuable for where we're going to go today. Payment rails are typically undervalued fintech because of complexity and revenues. That's 330 in English reduction. You take off that zero, it's 33, and we understand the power of that, and we'll get into the next slide and you'll see that as well. All right, so hopefully you guys are ready today. It's going to be a 14-slide presentation. I'm going to be breaking down a lot. We're going to be talking about, obviously, the payment rails in the fintech space, but we're also going to break down the more traditional in the older industries, and some people might say ancient, of the railroad industry and the natural gas pipeline industry, because in a lot of retrospects, there's similarities, even if they're not the same thing. And I know there's a lot of smart people who cover SoFi, PayPal, and other financial technology companies, and they might say, oh, you're comparing apples to oranges. In my opinion, I am not. In my opinion, the payments industry has a lot of similarities to the railroad and pipeline. It just has more technology, and it's transporting a different good, service. In this case, it's going to be money. So before we really get into the presentation, we have to understand why I'm bringing this up. Again, a lot of investors are confused on why PayPal is undervalued, why SoFi is not getting a better rating with Galileo in their technology business. And, you know, from this interview that Liz Thomas did with Anthony Noto, it brings in a lot of things, right? When I heard this interview, it helped me formulate, oh, okay, I understand now. Okay. And so we'll go to the interview, which you can go on SoFi's YouTube page and find it. But we're going to go to the 45 and 40-minute mark, and we're just going to let Anthony Noto talk, and then we'll come back here and we'll discuss it a little bit more.
Next one is the Moonshot move. If you had unlimited money and no regulations holding you back, what is a FinTech move that you'd make?
We would be much more aggressive in disrupting the existing payment rails across debit, credit, ACH, and other infrastructure plays. We'd be much more aggressive on the technology platform side, like unbelievably aggressive, and completely disrupting the incumbents across payments, the incumbents across deposits, the incumbents across the key underlying infrastructure that enables finance to happen in our country.
And as you hear him bring up, he said payment rails. He said it with an accent, I guess, that, you know, Northeastern accent, I guess, but he said payment rails, disrupting the traditional infrastructure. And this is the moonshot question Liz asked, right? The moonshot question: if you had the money, no regulation, what would you do? And he said he would focus on that. And I think, you know, that's really enlightening, because it also highlights the challenges with the payments industry as well. And the challenges in the payments industry are a little bit different than the railroad and natural gas pipelines, but that's where you're going to get that that mismatch in valuation and what people really aren't seeing, and why Wall Street is slow in this process to giving what these companies truly deserve. Because, you know, payments is not going anywhere. It's going to be a growing industry. Obviously, everybody uses money. Everything is being digitized, and we need to do it in a fast, safe, and efficient way. But there's a couple roadblocks within this industry that, you know, if you look at it from an objective point of view, you can understand why Wall Street is lagging behind a little bit. And so this is a great interview that Liz Thomas does with Anthony Noto. I would watch the whole thing. It's about 50 minutes long. And so he brings up payment rails, right? And so payment rails are like distribution companies. They provide a network that enables the flow of something, but in this case, the something is money and not physical goods. And when you talk about payment rails, you're like, okay, well, what companies are payment rails? We brought up a couple, but the OG payment rail, the one that's been around for quite some time, maybe the longest and the most notable, is PayPal. And, you know, I go on Google, is PayPal a payment rail? Yes, PayPal is considered a payment rail, as it functions as an intermediary platform that enables secure money transfers between individuals, businesses, and financial institutions, both domestically and internationally. Okay. And eBay acquired PayPal in 2002 for $1.5 billion. The acquisition aimed to make PayPal the official payments provider for eBay and boost electronic payments for auctions. The deal involved PayPal shareholders receiving 0.39 shares of eBay for each share of PayPal. In 2015, PayPal was spun off into an independent company, but continued to be used by eBay. So obviously there is a history with eBay and PayPal and with the payments network. And what I brought up earlier with the 33, if you've been watching my channel and if you understand gematria and how I use it, 33 is really important in my fundamental analysis of a company. You want to see a lot of 33s. And this is why, really simple enough, businesses equals 33. Okay, real simple. And if you're wondering, if you're new to this channel and you haven't seen how I use this numerical system before, please watch my previous videos, my how-to master classes, and I break it all down. We've had a lot of success using this with in conjunction with fundamental analysis. So if you want to add a little bit extra edge to your investing game, something that you should take a look into. And like I said before we really get into it, I am heavily invested in SoFi. It's one of my really long-term positions. I have my average right now at $7.12, which means I'm up 119% as we talk about this now on June 24th. The stock is over $15.50 currently, a little bit more. It's trying to edge up to $16. And if things continue to go well, I think we could see $20 before the end of the summer and $25 before the end of 2025. So we understand from that little tidbit we used, Anthony Noto, if he had the money and if no government regulations were involved, he would be very aggressive in investing in payment rails. Okay. So let's talk about the different payment rails. If you haven't really went through them all before, if you don't really understand them, because in a lot of aspects, I didn't know this was a thing. Like, I knew of the different sections, but I didn't realize these were actually called rails until super recently, until Anthony Noto said something. And so let's talk about the different payment rails. We have ACH, automatic clearinghouse. It moves money between bank accounts for direct deposits, bill pay, peer-to-peer. It typically settles within 1 to 3 business days. It has lower fees in general. Then you have card networks, and this includes credit and debit cards routed by Visa, MasterCard, American Express, Discover. Authorization is near instant, and settlement happens between 1 and 2 days. There are merchant fees attached to this, 1.5 to 3.5%, depending on who you use. You have wire transfers, direct bank-to-bank transfer, commonly used for larger and international payments. Domestic wires often settle on the same day. International ones take a little bit longer, and the fees vary. It could be up to $35 around about for sending domestically, and $25 to $65 internationally. Real-time payments, it was launched in 2017 by the clearinghouse. Payments are instant, irreversible, and available 24/7. I don't know a whole lot about real-time payments, to be honest, but it is a payment rail. Then you have cryptocurrency, decentralized rail using blockchain tech, Bitcoin, Ethereum. Transactions are processed via consensus across networks of nodes. Processing time takes roughly 10 to 40 minutes on average with the proof of work systems. And one of the newer payment rails is FedNow. The Fed's instant payment rail, piloted, and it was launched in 2023, I believe. 24/7 irrevocable transfers accessible to participating banks. Fees include about 4 or 5 cents per transaction, a cent per request, and a $25 monthly enrollment fee. Gotta be honest, I don't know much about FedNow, but this is one of the newer payment rails that have entered the system. And it's important to note, building a new payment rail is a complex and lengthy process, taking anywhere from several months to several years. The timeline depends on the complexity of the rail, the number of participating institutions, and the technology involved. For example, the development of FedNow, a real-time payment system in the US, took several years from initial planning to launch. And so that's going to be very important when it comes to Wall Street valuations. How long does it take for a payment rail to get up and running and to get transaction fees and to really to start making money? Because that's what Wall Street cares about. Is it making money, and is it predictable? That's very important to Wall Street. The U.S. digital payments market is projected to reach $3.49 trillion in 2025, with significant annual growth rate of 21.76% between 2025 to 2029, potentially reaching $7.68 trillion by 2029. This is according to Statista. Real-time payments are also experiencing rapid growth, with a projected market revenue of $40.4 billion by 2030, exhibiting a 31.8% CAGR from 2024 to 2030, according to Grand View Research. Okay, so the payments industry is a multi-trillion-dollar industry, and it's only going to be exponentially growing from here as more people become more digital. Cash becomes less in use. Okay, so this is a growing industry. Okay, and so that's where the edge comes in. Even though if payment rails are undervalued right now, at least we are in a space where it's growing. And for some gematria, we have payment facilitation equals 87 in reduction. And you see with the connection, we have SoFi, PayPal, USIO rail also equaling 87 in reduction. So you see the connection there. These are payment facilitation platforms, and those are the rails. Some more, we have payment processing, are quote unquote the rails. FinTech payment rail, undervalued. Business like a city in finance terms, which is going to be important when we go further. And payment rails connecting businesses, that all equal 137 in reduction. And then we also have payment processings, or the quote unquote rails, and FinTech payment rail undervalued, also equaling 160 in reverse reduction. So you see there's a lot of gematria connections here, and that's what we like to see to make sure we are in the correct spot. So let's talk about the payment checkpoints from A to B. Let's get into the pipes, the nitty gritty on why this is even an industry to begin with, because the goal is to lessen the checkpoints and to make it as seamless as possible. Okay. And so for the debit credit card payments, Visa, MasterCard, we have checkpoints of, the merchant POS system where you pay at, payment processor, card network, issuing bank, card network again, and merchants bank acquire. That's 5 to 6 checkpoints. Okay. And so you can see just with using your credit card, there's a lot of places that transaction has to go to before it can even be officially authenticated and be done. Then you have bank transfer. You have the sender's bank, the clearinghouse, the receiving bank. That's 3 checkpoints. And over time, that could take a couple days to us again to be authorized. You have wire transfer. Again, originating bank, SWIFT network or intermediary bank, and the receiving bank. It may include multiple intermediary banks for currency exchange and routing. And that's very important. As we become more of a global world and it's easier to connect, easier to transact, you could have up to 5 checkpoints for a wire transfer internationally. And so it's important to get those condensed and as efficient as possible. Then you have peer-to-peer apps like Venmo, Zelle, Cash App. You have your app provider, your link bank or card network, and recipient's account or wallet. Again, multiple checkpoints. And so we look at the summary, you know, on average, it's 3 to 4 checkpoints to get your money, or to pay for whatever you need. And so that's the issue at hand, right? With this industry, we want to consolidate all that and make it as quick, efficient, and seamless as possible, so there's no hiccups, right? The world's becoming faster, and so if we can streamline all these different checkpoints with you know, high class, high tech payments facilitation, that's where we want to be, and that's where the world's going. And so for some gematria, we have payment processing is pipeline, 333 English ordinal, 144 in reduction, and also 144 reverse reduction. Very powerful. Payment industry, railroad and sky, 380 ordinal, 137 reduction. 137 is the 33rd prime. And then we have payment processor, which equals 222 English ordinal. Then we have SoFi, PayPal, USIO, Rail, 222 English ordinal. But they also equal 210 in reverse ordinal. And then you have that reverse of 78 for payment processor and reduction, and 87 for SoFi, PayPal, USIO, Rail. And so you can see the connections here and how this is all aligning. So payment rails and digital commodities. Okay. Remember, we're going to connect this to the railroad industry and the natural gas pipeline industry, which they transport commodities, pipelines, natural gas, obviously. And, you know, with railroads, coal, you know, tanks of whatever. So what is a commodity? Commodities are a raw material used to manufacture consumer products. They are inputs in the production of other goods and services rather than finished goods sold to consumers. In commerce, commodities are basic resources that are interchangeable with other goods of the same type. The quality of a given commodity may differ slightly, but is essentially uniform across producers. When traded on an exchange, commodities must also meet specific minimum standards, also known as basis grade. And some key takeaways we have is a commodity is a basic good used in commerce that is interchangeable with other commodities of the same type. Commodities are most often used as inputs in production of other goods and services. Investors and traders can buy and sell commodities directly in spot cash market or via derivatives such as futures and options. Hard commodities refer to energy and metal products, while soft commodities are often agricultural goods. Many investors view allocating commodities in a portfolio as a hedge against inflation. Okay, so that's a traditional commodity, right? In certain systems, money was a commodity. Gold coins, silver coins, and other precious metals were used as money. These had intrinsic value. The metal itself was valuable. This was called a commodity money system. And so, okay, we understand what a traditional commodity is. We understand that commodity money could be a commodity. So when is technology a commodity? Technology is considered a commodity when it becomes standardized, widely available, and interchangeable between providers. Competing products or services offer little differentiation. So, for example, cloud storage is a commodity. Google Drive, Dropbox, OneDrive is standardized, widely available, and interchangeable between providers. Processors and memory chips, when standardized. Internet bandwidth, generic software tools, email clients, web hosting. In these cases, prices become the main differentiator, not innovation. In foreign exchange markets, money currencies is traded like commodities. Bitcoin and other cryptocurrencies are sometimes debated as either commodities, securities, or currencies. And the U.S. Commodity Futures Trading Commission, CFTC, has classified Bitcoin as a commodity. So this is where we're at in the modern world. Bitcoin is a commodity. And so we need to understand a digital thing like that is going to, cause a shift in everybody's perspective in how we transfer funds. And so just for the summary, modern money is not a commodity, but fiat is a medium of exchange. Commodity money, like gold, silver coins, was used historically. In specific markets like Forex or crypto, money can be treated as if it were a commodity for trading purposes. And so this is all just getting us ready to where we're going, right? We're going to go back in time to understand where we're going for the future. Goods transportation before railroads. And so there's just a couple examples of how goods were transported before the rails became a big thing. Wagon and ox team transport, overland routes. So obviously you just get a horse, get an ox, get a wagon, and you just pile it up, go onto the dirt road, and you get there. Common overland routes included the Santa Fe Trail, Oregon Trail, the California Trail. Travel was slow, about 15 to 20 miles per day, and subject to weather, terrain, and hostile encounters. So it was dangerous. It was slow, and it was very dangerous. River transport, you have flatboats, keelboats, and later steamboats were crucial for transporting goods via rivers. Major rivers like the Mississippi, Ohio, Missouri acted like trade highways. Goods could be moved relatively quickly downstream, but upstream travel was difficult until steamboats became common in the early 1800s. So you could get downstream, but going upstream without a steamboat and that power, it was not worth it. Then you had coastal shipping. For East Coast cities and even cross-country transport via Panama, later used it by the gold rush, coastal schooners and other sailing ships were used. Goods moved between cities like Boston, New York, Charleston, and New Orleans because they were on the coast. It was also possible to ship goods all the way around the Cape Horn to California. It was just long and dangerous, but it was used during the gold rush era. Then you have portage and pack animal routes in mountainous and forested areas where wagons can travel. Goods were carried on pack animals, mules, horses, or even porters on foot. Native American and early settlers often formed the basis for these routes. So sometimes you just had to do it yourself. You either had a mule, a horse, or you just had to carry it yourself. Again, dangerous, slow, and now you're putting your human capital, your own labor at risk of injury. Then you had canals. Man-made waterways like the Erie Canal, completed in 1825, allowed goods to be transported officially by barge. The Erie Canal connected the Great Lakes with the Atlantic via the Hudson River and was a major trade route before railroads. And so you could see all the difficulties to try to transport goods around America early on before railroads. Before railroads, transporting was slow, costly, and often dangerous, relying heavily on natural waterway, animal power, or sheer endurance. The advent of the railroad in the mid-1800s dramatically transformed the speed and volume of goods transported across the continent. So we understand the importance of the railroads, okay? Sped things up, more efficient, less dangerous. And so let's talk about natural gas transportation before pipelines. Before pipelines became the dominant method of transporting natural gas, late 19th and early 20th century, natural gas was moved using a combination of very localized, rudimentary, and inefficient methods. Localized is key. You really couldn't move it that much. Local use at the source. In the earliest days, natural gas was often used right at the wellhead. For example, some 19th century gas wells in Pennsylvania and West Virginia piped gas directly into nearby homes, factories, and street lamps using short iron and wooden pipes. So it had to be very localized to get the benefit of using natural gas. Wooden and cast iron pipes for short distance. The first crude pipeline started in the 1820s and were made of wooden logs, bored and joined together and sometimes sealed with tar or pitch. By the 1870s, cast iron and wrought iron was allowed for more durable and higher pressure transport, but were still used only for local or municipal networks. So we're not getting out there in the world, in North America. It's still very localized. Maybe you could get it down the street or across the city. Compressed gas cylinders, it was rare and inefficient. Natural gas was sometimes compressed and stored in metal cylinders, similar to how propane is handled today. The method was rare, expensive, and mostly used for lighting gas and lamps, not a large scale. So it really wasn't a big use to really scale out and help America like it does today, energy-wise. It was converted into gaslight, manufactured gas. In urban areas before natural gas pipelines were feasible, cities often relied on manufactured gas, also known as coal gas, produced by heating coal in a controlled environment. Though not pure natural gas, this gas was distributed via municipal pipe networks for lighting, heating, and cooking starting in the early 1800s. And early on, the limited early long-distance pipelines, the first successful long-distance pipeline was in 1891, running about 120 miles from Wells in central Indiana to Chicago. This marked the beginning of natural gas being viable for broader commercial transport. Before modern pipelines, natural gas was either used near the wellhead, transported in short iron or wooden pipes, or not used at all due to transport limitations. It wasn't until the late 19th century, and especially 20th century, where the advances in steel, compression, and welding made long-distance and high-pressure pipelines practical and widespread. And so we understand where those two industries were before the infrastructure came and the technology came for them to scale out. You have to think of that the same with the payments industry. All right. You might think this is boring. You might think this doesn't apply, but it does. You know, history doesn't repeat itself, but it rhymes. And it's rhyming right now with the payments industry. So again, you might not think this makes a whole lot of sense for the payment industry, but it does. And this is what Wall Street is looking at. Okay. So this is why you need to be paying attention, because this gives you perspective on why the payments infrastructure is lagging in regards to valuation in the stock market. How long to build a railroad? Building a modern rail line, especially for transcontinental route, can take a significant amount of time, with estimates ranging from 20 to 57 years. 20 to 57 years. Factors like permitting, construction, and potential legal challenges can all influence the timeline. For example, Trains magazine estimates a transcontinental rail could take around 57 years, with permits taking 36 to 48 months and construction to 24 to 36 months. Okay. So for permits taking up to 4 years and construction taking 3 years for just the network, right? Just to get started, it could take 4 years. And just to get your first line up before you even get into the next state could be another 3. So that's 7 years before you really are even cooking. And when you're talking about investment in that plays a role. So if you're going to invest in a railroad, you're not going to really see any money coming in until year 7. That's very important, right? And it depends on the project length too. A 500-mile new line across open country, for example, would likely take around 60 to 72 months, 5 to 6 years total. But this can be affected by factors like political opposition, construction techniques, and legal challenges. So just to get 500 miles in open country, in open space, without any issues, could take up to 6 years. America is over 3,000 miles, right? So you can see how all that starts to add up. And so now let's talk a little bit about, well, first before we're getting that, let's go to this example first. The Baltimore and Ohio Railroad took approximately 25 years to reach the Ohio River. Construction began in 1828, and the rail line reached Wheeling, West Virginia on the Ohio River in 1853. The initial 13-mile stretch between Baltimore and Ellicott opened in 1830. And so now let's start to put our investing cap on and go through the pros and cons of the railroad industry if you're going to invest. So the pros, right? Strong economic moat, high barrier to entry. It costs too much money, too much time, takes too long to get an operation up and running and start making money. And so if you're a company that can do that, you're going to be one of few, or just one of one. And once infrastructure is in place, profit margins can scale significantly with rising volume. Once you have the platform and the volume comes in and out, that's easy money at that point, but it takes a long time to get there. Many major railroad companies often offer reliable and growing dividends, appealing to long-term investors. So once the investment's made and once the investment starts bearing fruit, is very reliable, is usually on the safer side, and it provides a dividend that can grow over time, really appealing to long-term investors. And so the downside to investing in railroads is the infrastructure development. Building tracks over mountains, rivers, and through underdeveloped land was extremely difficult and costly. If you didn't have a good plan in place, if you didn't have good construction people doing it, you could lose a lot of money, right? Heavy regulation. The ICC tightly controlled pricing and route decisions, stifling innovation and adaptation. You know, if you're an investor that doesn't like to see a whole lot of regulation, well, from the 1880s to 1970s, railroads probably wouldn't have been a good call for you because it was highly regulated by the government. And there was a lot of boom-bust cycles. The rapid expansion often led to speculative investment and financial collapse. The Panic of 1873 was triggered by a railroad overbuilding. And so you have the pros and cons involved, and hopefully you could see why when you relate that to the payments industry, how that could lag, right? And we'll get into those moving forward. And so the historical average price to earnings ratio for a railroad company has been 15 to 20. Okay. And keep in mind, as of June 2025, the S&P PE ratio is 27 going on 28. So well below the S&P average. Okay. And so you have to keep that in mind as well. The recent range has been 18 to 24. It's slightly above the historical average because of high efficiency, pricing power, strong free cash flow, and market confidence and earnings stability. And, you know, they do have a lot of technology that they're operating with now in the rail industry. So that's going to give them a little bit of an extra boost. How long to build a pipeline? All right. And so the average time to build a natural gas pipeline could, you know, vary significantly, but it generally takes 3 to 4 years from conception to in-service for interstate pipes. This includes planning, permitting, and construction phases. The longest natural gas pipeline in the world is the West-East gas pipeline in China. While it's the longest, it wasn't actually the one that took the longest time to build from start to finish. The main trunk line was completed in 2004, and that took about 10 years to complete. And it took about 10 years to complete the entire network. And so for the longest pipeline in the world, it took about 10 years, okay? And so it began in 2002 and was completed in 2012. Not a short time frame at all. And as an investor, you're putting that in mind, right? You know, you're not going to start seeing the full fruits of that labor until 10 years down the road. And so here are some of the pros and cons in investing in the midstream natural gas companies. And so that's what I want to bring up. This is more of a midstream. It's not downstream, and we're not getting the gas out of the ground. We are just transporting the gas, right? Just like in payments industry, we're just transporting the money. So that's why we're staying in midstream. Stable cash flows when investing in midstream, right? Midstream companies typically operate under long-term fee-based contracts, not tied to spot gas prices. You have to consider that for the payments industry. Long-term fee-based contracts, not tied to spot money prices of whatever money or whatever crypto or stable coin that's being transferred. If you transfer it, you still got to pay the fee, okay? And this makes the revenue more predictable than upstream producers who are subject to commodity swings. And so that's the benefit for Wall Street. The revenue is predictable once things get up and running. If Wall Street can understand where the money's coming from and what they're going to be getting year 1, year 2, year 3 down the line after construction, then they can start really evaluating the business. And some cons, some risks. You know, you have interest rate sensitivity. It's a capital intensive business, obviously. And it's always going to require ongoing infrastructure investment. Debt levels can be high, and large projects can take years to become profitable. Regulatory and political risk, that's a huge thing. When investing in midstreams, you know, you could deal with different political regimes. Are you are you trying to get a pipeline in an environmental place that maybe it shouldn't be going? Permits can be delayed, blocked, a whole lot of things. You know, tax complexities is another one, and you know, growth versus income trade-off. When dealing with these type of midstream distribution type of companies, the growth can be stagnated sometimes, right? The income will come in once it's all set up, but it's not like you're going to continue to just grow indefinitely. It's not possible. It's not feasible, and it's not economically smart, right? At some point, you just got to start throwing off the cash to investors and take what you get. The average PE ratio in the U.S. gas midstream sector is around 14.65x in mid-2025, so almost 15. Again, the S&P is almost at 28 overall for their PE, price to earnings. So you can see that's almost 10. I mean, it's over 10 points less. Okay. So it's not a sexy industry by any means, which goes into play for Wall Street valuations. And so now let's get back to the payment rails, or let's get back to the businesses that have payment rails. So we went through first what a payment rail was, what the similarities were in regards to railroad and pipelines, the pros and cons to those traditional businesses. Now let's get into what these businesses who have payment rails, what do they actually do within the payment space? You know, so Galileo is a part of SoFi. SoFi bought Galileo a couple years ago, wholly owned by SoFi. Galileo Financial Technologies is a leading financial technology company that provides a comprehensive platform enabling fintechs, banks, and brands to develop and scale innovative financial products and services. Headquartered in Sandy, Utah, Galileo operates as an independent subsidiary of SoFi Technologies, Inc. If you know me, I live in Salt Lake City, so I'm not too far away from Galileo myself. Galileo was founded in 2000, and some of the core offerings are card issuancy, payment processing, digital banking solutions, lending services, fraud management, wire transfer capabilities. Some recent innovations have been co-brand debt rewards programs, payment method switch. The clientele that they usually like to mess with is by a diverse range of clients, from digital banking pioneers to established financial institutions, including companies like H&R Block, Dave.com, MoneyLion, SoFi, and Monzo. And so now this is a little misleading because we're talking about undervaluation. So the reason why SoFi has a PE of 34 right now is partly because of their loan platform, high quality management, and overall retail investor sentiment, right? SoFi has been on a run. We said 6 months ago, a year ago, grossly undervalued. Okay. So on regular PE standards, yeah, it's above the S&P 500 right now. But it could be argued it could be a lot higher if Wall Street actually gave Galileo's tech platform the respect it deserved. But you have to understand why Wall Street is late to the game on this. And Galileo says it itself. It takes roughly 1 to 2 years for revenue generated by Galileo financial technology clients to be fully reflected in SoFi's financials. SoFi acquired Galileo in 2020, and the full integration of Galileo's platform, including revenue recognition technology, takes some time. For example, SoFi's bank, which relies on Galileo technology, is expected to be a top 10 client on a revenue basis for Galileo once full transition is complete in early 2026. They bought the company in 2020. They're not going to be fully up and running on SoFi's bank to 2026. That's 6 years. All right. So you can see that similarity where, it's digital infrastructure, but it takes a long time for this digital infrastructure to be fully realized. And any revenue is going to take 1 to 2 years to hit the balance sheet for SoFi. So this is where the discrepancies of valuation come into play. When people say, I don't know why SoFi is not getting the respect it deserves, if you look under the hood a little bit, you can see why. That's our opportunity if you can see the forest beyond the trees, all right? If you have a long-term horizon and you understand the business at hand. What does PayPal do? PayPal was founded in 1998. PayPal is grossly undervalued, It's sitting at a 14 PE, right? It's sitting at a PE with natural gas midstreams. It's sitting at a PE lower than the modern railroad company as a fintech. Why? Why is that, right? You would think that's, blasphemy. And it is, but you have to realize what Wall Street is looking at. And so first, before we get into that, let's go into the core services. They have digital wallets and payments, peer-to-peer transfers, buyer protection. They have payment processing, financial services, and risk management for businesses. And so when you talk about this gross undervaluation for PayPal, I saw this amazing interview with this investor, Adam Sissel, on the Investors Podcast Network, and he breaks it down. He says the reason why, and he was mostly talking about technology companies, but this applies to fintechs as well. All right, so the default treatment for research and development costs under GAAP principles is to expense them in the period they are incurred. This is because the future economic benefits of R&D are often uncertain. And Adam Cecil brings up a great point. When you're a software-based company, like many are in the tech space, like PayPal is in their space, that leads you to a natural undervaluation, because your research and development is going towards tweaking your software. It's not actually always going to be about, trying to create a new product or have a new invention. Your research and development is just to tweak a platform you already have. And an asset is something that has a life longer than over a year, essentially. And so for PayPal, they've had their software and their app and their platform set in stone. It's not like that's going anywhere, right? That's a long-term thing. It's going to be here for many years in the future, right? So when they're tweaking their platform, that still is going under research and development. It's not being capitalized. And so we have some numbers here for PayPal. You can see the revenue, you can see their cost of goods sold, and their gross profit, right? So this was in 2024. Their research and development expenses was $2.9 billion, almost $3 billion. Okay. That's a good chunk of money. Imagine that being capitalized. Imagine $3 billion of PayPal's research and development being recapitalized because it's just tweaking the software. Now, it might not be the full 3 million. Say it's 1.5, right? A 1.5 billion being reinvested back into their platform. That's significant, and that would show up on the balance sheet a lot more positive, right? But since GAAP accounting doesn't account for that, Wall Street, it's not, Wall Street's smart, but they're lazy at the same time. They're going to go off the basics. And so for some gematria, I have GAAP R&D tends to undervalue a FinTech, which is 330 English ordinal. And when I heard that from Adam Cecil, man, that made so much sense to me. And that actually cheapens techs in general too. In a lot of cases, there are a lot of tech companies out there that are overvalued. But when you realize their research and development line item is most likely not being capitalized, you can see there's a discrepancy in valuation that Wall Street really doesn't account for. So that was very interesting to me when I came across that. So what does USIO do? And in my opinion, I'm invested in USIO. As you see, I have 1,500 in. I'm down 14% right now. But I mean, it has a current PE of 11. It was established in 1998, just like PayPal. And it's grossly undervalued, even more so than PayPal. Obviously, it's a small cap company. It's a micro cap company. It's not as well known. And so there's a lot of things working against it outside of it just being an infrastructure payment facilitator. But, some of the core services offerings, integrated payments, ACH processing, card issuancy. They have a print mail service and consumer choice with, debits, credits. And it has, strategic growth and acquisitions that acquired Akimbo Financial in 2019 and enhanced USIO's prepaid card issuing and program management capabilities. And information management solutions, IMS, which was output solutions with the print and mail service and stuff. So it's almost a full pure play payments company outside of the print and mail service. But what they're doing with that is they have their clients with that, and over time they're digitizing their clients. They're getting over them to those other segments. And so this is the most grossly undervalued out of all the things we went over today. But again, infrastructure plays. It's not sexy. It takes a long time for revenues to be realized, and a lot of the research and development's not being capitalized, which hurts the balance sheet. And to almost cap this all off, let's look into the future and why I'm still very confident and bullish in this sector and industry long term. It's the stablecoin transportation on payment rails. We've already talked about how the trade commission commodifies Bitcoin and stablecoins. Tether is a stablecoin and is considered a commodity. It's stablecoins is a cryptocurrency designed to maintain a steady value. It's typically pegged, for Tether's case, the US dollar, but it could be pegged to gold. It could be pegged in other things. Walmart and Amazon are looking into issuing their own stablecoins. So if they did a Walmart coin or Amazon stablecoin, the value would be maintained and pegged to their products to be bought at their place of business. And so here are the top stablecoins right now. We have Tether, we have Circle, we have USDS, DAI, PayPal stablecoin, and Pax Gold. So we're still in the early stages. There could be a lot more corporate coins to come, right? This might change in 10 years. PayPal might be higher. PayPal might not be on the list. It might be somewhere else. And then for some strong gematria, we have transporting a commodity equals payment processing companies distributing stablecoin equals 333 English reduction. Payment companies convert fiat to stablecoins to transport internationally to customer equals 333 English reduction as well. Transportation of stablecoins via payment processing companies, much like railroad, equals 333 English reduction also. So that's the future I see. That's way down the line because we still have to build the infrastructure just for currency, just for, the dollar itself, the digital dollar that's coming. I mean, we're really digitized now, but you know what I mean. But this is all coming down the pipe, and this is what the future holds. It's just going to take a while, and Wall Street's discounting this fact, right? This is not an overnight process. This is not a typical software play where it's like, say, it took Microsoft a long time to grow, but say Microsoft Office, was invented tomorrow and they start selling it, right? That could scale up super quickly. You don't need a whole lot of infrastructure to sell Microsoft Office, to start generating revenue off Microsoft Office once it's already set up. So I'm excited for stable coin transportation on payment rails moving forward. And so to end this presentation, I know it was long. I know it might not make a whole lot of sense of why I'm talking about railroads and natural gas pipelines, but it all applies. It all applies. History doesn't repeat itself, but it rhymes. At Wall Street, they're smart, but they're lazy. And you have to keep that in mind. So the key points to payment rail, fintech undervaluations is similar to railroad pipeline distribution business model, which historically have lower valuations. It takes significant time and engineering capital to set up rails and close deals. Sometimes, it could take 3 years for a client to be onboarded, and it could take 3 years for a client to be offboarded as well. Okay. Research and development on software maintenance is expensed, not capitalized. In early stages of adoption, no predictability in revenue. It's still a black box, still very complex. And it really doesn't show up on the balance sheet of where that money is coming from and how that money is generated. You say it's fees, but the fees are complex and such. So it's hard to really get a grasp on why. Like, we know the payment rails and infrastructure is important, but it's tough to justify it if the revenue's not coming in yet, right? And it's the threat from traditional financial and technology companies. When you look at JP Morgan, Wells Fargo, Bank of America, they're traditional, They're old, they're clunky, but they're still a threat. Who's this? They have a lot of money. Who's to say they don't strike gold out of nowhere in their research and development department and make a fabulous payments infrastructure system? I doubt it, but it's still possible, and they're still in the game. They're still competing against SoFi, PayPal, USIO. Same thing with technology companies, and the technology companies maybe even be more of a threat because they have the mobility. They also have the money, and they have the futuristic mindset for it. Okay. Amazon is a tech company. They have the money, and they're trying to get in stable coins. They already have logistics for payments and stuff like that on their Prime. So they could knock out some other payment processing companies, right? If they get it correct. That's just an example. So that's what I have today for you guys, y'all. Hopefully you guys love this presentation. You know, I enjoyed doing this presentation. It took me some time to do it. And again, for people who have not been on my channel before, please give me a like, subscribe to my other channels that I have in the link in the description below. But I want you guys to keep an open mind about this, okay? I just gave a perspective on why these companies in this industry is being undervalued, even though it's technically in technology and in financials. I think there's, you know, these are some valid reasons as to why Wall Street's, you know, late to the party to give it the respect it truly deserves. But just as Wall Street's late to the party, they're very quick to overvalue companies as well once they see the results they need to see in predictability and cash generation. And so let me know what you thought about this presentation in the comments. My name is Art Turner, Data Productions Media. Dreams are tangible, aspirational, where we scheme our dreams to existence. I love you all, and I'll see you in the next video.